There's a real danger of something happening on an exchange where the exchange just can't make good with physical metal for the demand from futures contract traders, and they default. In other words, they pay in cash instead of in silver, and then everybody in the world sees that and says, "Oh, we're out of silver," and so then the panic buying starts. And I think that's a very possible part of the silver story going forward. And I think that $100 an ounce is. It'd be shocking if we didn't get there somewhere along the way. And it's possible that much higher prices could happen when the panic buying starts.
Silver is flashing a rare historical signal that has analysts and investors taking notice. The gold to silver ratio, a key metric comparing the relative value of the two metals, has surged above 100, a level seen only a few times in the past century. This extreme divergence suggests silver is significantly undervalued relative to gold. Historically, it eventually reverts whenever the ratio climbs this high, often with silver delivering outsized gains. Veteran market analyst John Rubino highlights the current disconnect, noting that even if gold prices remain stable, silver could rise substantially to restore balance. With industrial demand for silver rising and physical supply tightening, the metal's potential upside looks increasingly compelling. The divergence between the two metals has been especially stark in recent months. While gold has soared to record highs, silver has lagged, pushing the ratio back to levels last seen during the COVID-19-driven market turbulence in 2020. This widening gap means it now takes more than 100 ounces of silver to buy a single ounce of gold, underscoring silver's relative underperformance. Adding to the bullish case for silver is concern over physical supply. Rubino warns that exchanges like COMEX may one day be unable to fulfill physical silver deliveries for futures contracts, so they opt for cash settlements due to limited availability. Should such a scenario unfold, it could trigger a scramble for physical silver, driving prices sharply higher, potentially surpassing $100 per ounce. While April is traditionally a minor delivery month for silver, volumes were extreme this year, second only to February. However, compared to previous Aprils, delivery demand marked a significant decline. Interestingly, silver inventories on the COMEX have continued to rise, in contrast to gold, which has seen stockpiles stabilize. Registered silver, the portion available for delivery, has experienced a notable jump, reflecting recent restocking efforts. Yet despite the increase in supply, open interest in silver futures remains relatively low, signaling that many market participants are waiting on the sidelines for a clearer direction. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, silver is a great story because it's an industrial metal that's already in deficit. The world's silver mines don't produce enough silver to satisfy the missile makers and the solar panel companies and all the other people, myriad people who use silver. So there should be upward price pressure on silver as the deficit continues and maybe turns into a shortage just from the industrial side. But silver is also a monetary metal, right? And it trades, like you said, in a range with gold, where maybe from a gold ratio of 30, that's how many silver ounces it takes to buy a gold ounce, up to 80 or 90 or something like that, and the higher that number goes, the cheaper silver is relative to gold. And 90, where it takes 90 ounces of silver to equal an ounce of gold, is usually a screaming buy signal for silver, because it means it's at the top end of its range or at the bottom end of its price range. So it's very cheap, and it's going to outperform gold going forward. So all gold has to do is sit there, maintain its price, and silver should go up when it's at 90 or so. Lately, it was over 100. That is a screaming buy for silver. Historically, whenever silver gets up to 1/100th of an ounce of gold, or down to 1/100th of an ounce of gold, usually it gets bought up, and gold or silver goes up in percentage terms much more than gold does. Usually that happens in a precious metals bear market. So it's both of them going up, but silver going up more than gold. And I think that's a completely believable scenario going forward, because, silver is, because it's in deficit, we're using up the previously existing silver. And that means there's just less of it around for somebody like the COMEX to satisfy futures contracts who show up and want to turn their contract into silver. And so there's a real danger of something happening on an exchange where the exchange just can't make good with physical metal for the demand from futures contract traders, and they default. In other words, they pay in cash instead of in silver, and then everybody in the world sees that and says, "Oh, we're out of silver," and so then the panic buying starts. And I think that's a very possible part of the silver story going forward. And I think that $100 an ounce is. It would be shocking if we didn't get there somewhere along the way. And it's possible that much higher prices could happen when the panic buying starts. So we'll see. But I think, if you're a stacker and you're trying to decide whether to buy silver coins or gold coins right now, I would say silver is the better buy relative to gold, although you should probably be buying both if you're able to. It's not just about investing, because there are so many things we should be doing with our lives that probably fall under the category of prepping, right? If the world is going to get very chaotic, which it is one way or another, we should be as self-sufficient as possible. So besides stocking up on gold and silver to protect your finances, you want to make sure you're indispensable at work, and make sure you know as many people in your community as possible, so you've got their back and they've got your back, and learn how to grow some food. Designate somebody in your family as the family gardener and have them try to grow 1/3 of your grocery bill or something like that, and those are all things we should have been doing all along, but now it's more necessary than ever. And the other thing is that a healthy psychological way of looking at all this gloom and doom is to think of it as an investment thesis. Because, all this crazy stuff is happening out there, but if you play it right, it can make you rich, and that is so much healthier than just looking at the world and thinking, "Oh my God, everything's falling apart. This is terrible," and just wanting to curl up in a ball, and whimper. But if you think of it as, okay, $10,000 gold, I will look forward to that, and then so you can get through this stuff with a better attitude.
Gold prices recently pulled back to a 2-week low near $3,235 during the early Asian trading session on Friday. Easing trade tensions between the U.S. and its global partners reduced the demand for safe haven assets. This shift in market sentiment has put some pressure on gold, which had previously surged past $3,000 with little resistance. Analyst John Rubino suggests that gold's recent rally was driven by substantial, non-price-sensitive demand from central banks and institutional investors, which provided a strong foundation for the metal's climb. The structural support provided by purchases from major entities like BRICS nations and the Basel III reclassification, which has increased gold's role in the global financial system, ensures that gold is well positioned to maintain its value or continue rising despite the potential for short-term corrections. One of the key drivers behind gold's resilience has been the People's Bank of China, the largest net gold buyer for over 5 consecutive months. In the first quarter alone, China added 27 tons to its reserves, cementing its position as the largest gold holder in modern history. At the $3,300 price level, gold has considerable potential to continue its upward trajectory, particularly if the trade policies under the Trump administration are resumed, which could reignite inflationary fears and prompt further demand for the precious metal. Let's get back to the interview.
Gold has had an epic run, and it's been very quiet. I mean, it took forever to get above $2,000 an ounce. And then it seems like it went above 3,000 in the blink of an eye. It just did it, and nobody was really very excited about it as it was happening, other than, gold bugs like me who were watching it every day. But because it happened on a stage where a lot of other intense things were happening, because we had, NVIDIA and the other AI chip stocks going through the roof, and Bitcoin going up to $100,000. And so a lot of even bigger things were happening while gold was doing its thing. But now, gold is one of the few things that hasn't really corrected hard. And I'm going to jinx it. It'll probably drop back down to $2,000 an ounce if I start saying stuff like it's not correcting. But so far, it's held up pretty well above $3,000 an ounce. And I think that is true. The fact that gold is holding up better than most other asset classes for several reasons. One is the BRICS country central banks continue to buy a lot of gold because they still have their their frustrations with the dollar being used as a weapon and their desire to get beyond the reach of U.S. authorities. So they're thinking ahead to the days when they might set up a gold-backed trading currency for trade among themselves so they can just bypass the dollar. And they've still been buying gold with that in mind. And then the other thing is the Basel III implementation. There are new banking regulations being implemented around the world, and they raise gold from a tier 3 asset, which isn't a great thing to hold, to a tier 1 asset, which is excellent for banks to have on their balance sheets. It's a very useful asset. It puts it, being tier 1 now, puts it in a class with treasury bonds and US dollar cash. So banks around the world are probably buying gold in anticipation of having it become a tier 1 asset on their books and then using it as a tier 1 asset. So that's a lot of demand out there. And that is a big part of the reason why gold has gone up steadily and without a lot of price sensitivity. You would think when an asset goes from $2,000 to $3,000 that you would have massive resistance at $3,000 because humans like round numbers, big round numbers. And so, a huge number of sell orders ought to be sitting at 3,000, but apparently not. Gold just broke right through that. So, and that's probably wise because central banks and large commercial banks are out there doing things with gold in a non-price sensitive way. They're just buying it because they need to own it. And we'll see how long that goes. I think both of those factors, the BRICS thing and the Basel III implementation, are going to go on for a while. Those aren't things that just end one day and it's over. So I think gold still has the wind at its back, although it's going to correct. And bull markets always have corrections, but it's got the banking wind at its back, which is a good thing for it, at least maintaining its current price and maybe going higher from here. Gold is someplace you hide out in chaotic times. And we are in chaotic times right now. So people who are worried about, the tariffs and the trade war generally causing prices to spike, causing, the inflation indexes to go way up, and that to destabilize the financial system, are probably buying gold too, just so they can hide out and not be affected by all of this stuff. So yeah, we live in a chaotic world. And, when we spoke a year ago, I probably said some things about the Ukraine war being very destabilizing because we're kind of blundering into World War III. Well, now that's less destabilizing. It's, they're actually talking and maybe we get that settled pretty soon. But there's a lot of pressure on the U.S. government to start bombing Iran now. So we could start a different war in a slightly different part of the world that has its own chances of causing World War III. And that's very destabilizing too. So that's the kind of thing you buy gold for. If the U.S. is getting ready to bomb a major oil producing country, then you want as much of your portfolio as possible to be in very stable assets or places. And so gold fits that bill too. So yeah, it's got a lot of stuff going for it right now.
Silver's current underperformance relative to gold, reflected in the historically high gold to silver ratio, suggests a potential upside for the metal as it seeks to rebalance with gold. With rising industrial demand, a tightening supply chain, and the possibility of physical delivery constraints, silver may be poised for significant gains, especially if a supply squeeze occurs. On the other hand, gold's continued strength is supported by robust institutional buying and strategic stockpiling by major players. While the precious metals market may experience short-term fluctuations, gold and silver seem well-positioned to weather ongoing economic uncertainties. Could silver be setting up for a sharp rally, or will its lag behind gold persist amidst shifting market conditions? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.